This is the Financial News Network. I'm Christy Duffy. Yahoo reporting its fourth quarter earnings after the closing bell Tuesday and announcing a slip in revenue and further layoffs. However, the company did more than double earnings from last year. Joining us live on the phone to discuss is analyst Bolan of Williams Capital. Thanks for coming on, Brian.
Thanks for having me.
So Yahoo saw a 12% drop in revenue over last year. So is the hike in earnings solely due to layoffs and austerity measures?
You know, there was a hike in earnings, but I think the bigger picture is that there was a change in accounting policies. Mm-hmm. So in the past, the company would take traffic acquisition costs and back that out of revenue, and now they're adding that back into revenue. We think that this is an aggressive move, and basically done off the heels of the Demand Media IPO, which priced last night fairly strong, we might add, but still at the same time we believe it's an aggressive accounting issue, and it's adding costs back in, and so I think the numbers here need a little bit more time to be fully digested, but I think as we look forward, we have suspended our model until we get further clarity on how the traffic acquisition costs are being added back in, and we have, as a result, downgraded the stock from market perform to market underperform.
Well, Yahoo has been falling behind further in the race for online advertising dollars against competitors Google and Facebook in a space that is increasingly competitive. What did the business note as a plan to really push forward and gain some market share?
You know, the plan for gaining market share is really more about getting more participants online and doing more online advertising, the shift from offline advertising to online advertising. Mm-hmm. Certainly in the display category, Yahoo is a leader in that market. The company noted 3 very large consumer-based companies that were increasing their display budgets with them. But at the same time, everyone's pointing to search. Search is obviously a much more profitable part of the business, and that's where Yahoo is losing ground fast. So in terms of market share, we would expect maintain to increase in display, but continue to lose market share inside of search.
Well, many investors are perhaps questioning at this point if CEO Carol Bartz should stay in her position. She's now past the halfway point in her 4-year contract at the company. What's your take?
I would say that she's probably going to remain on through the end of the year, but it depends on how performance is over the next couple quarters. If it's really bad, there could be a move to push her out. If not, she's likely to stay through the end of her contract.
And the share price is down early Wednesday pre-market following the earnings release late Tuesday. You mentioned earlier your new rating on the stock, but what's your overall outlook? Can you give us a price target?
I can't give you a price target right now because my model is under review, so we're suspending all estimates. What I can tell you is on the call, the company noted that there was no share repurchase. When last quarter there was a significant amount of share repurchase activity going on, and they noted back to the fact that they would be disciplined inside of share repurchase and said that they bought about $100 million worth of stock at $14.68. If you think about it, this effectively sets a floor inside of investors' heads of where Yahoo is going to come in and support its own stock. So a $14.68 is something where they think that that's where a good value is. But clearly, when the stock is around $16 or maybe 16 and change, they do not believe that it's worthwhile to be reinvesting in the stock. So as we look forward to what a potential price target would be, assume that it was going to be less than the market price at this time.
All right. Thank you so much, Brian.
Thanks for having me.
Analyst Bolan of Williams Capital. For further analysis on earnings and more, stay tuned to the Financial News Network. I'm Christy Duffy.